I believe you are good wherever you are, and I hope you can see what is appearing on the board. We are taking advanced management accounting, and we are taking chapter 3. We are taking chapter 3. So far, we have completed chapter 1 and chapter 2. So we are taking chapter 3 if you have been following. So if you have not been following, just go to our YouTube and you can get some of our lessons there. If you need any help, you can still contact us through our numbers. I'll give you our contacts by the end of the lesson, and I believe most of you have our numbers, and you can get us for assistance or any help anytime that you need our assistance. Now, let me remind you what is in advanced financial management. That is chapter 1 is about theory, which we covered. Chapter 1 is about strategic management accounting information. That's purely theory. Sources of strategic management accounting information. Number 2, role of strategic management accounting is strategic planning and control. Then governance and control of strategic management accounting information. Scope and limitations of management accounting. And then ethical standards for management accountants. We covered the chapter 1, which is about theory alone. That's just around 2 pages or 3 pages at most, as far as our classes and discussions that we did previously is concerned. So we covered chapter 1, which is about strategic management accounting information. Then chapter 2 is about cost estimation and interpretation, which we covered, and most of these lessons you find them in our YouTube. Ordinary least square method. Single and multiple predictors, tests of significance, that is goodness of fit. ANOVA, that is analysis of variables. P-value, economic plausibility tests, significance of independent variable tests. Specifications, that is assumptions of ordinary least square. Applications of serial correlation and multicollinearity. Computer output and technical versus managerial interpretation of ordinary least square results, the learning curve models and their applications. So yesterday we concluded with learning curve. We know what learning curve is. So that was the end of chapter 2, which we have concluded so far. So we are moving to a new chapter, which is chapter 3, is about planning and decision-making techniques. In chapter 3, you find that there is cost volume profit analysis, that is CVP. The other name for CVP is break-even point. So when we are talking about CVP, we simply mean break-even point. That is for single and multiple products under conditions of uncertainty. At management accounting intermediate level, you need break-even point for a single product, and most of you do not have any challenge as far as break-even point for a single product is concerned. I will focus mostly on break-even point for multiple products. So that is one of the items that you find in chapter 3. I've told you chapter 3 is about planning and decision-making techniques. So CVP, Then after that, you take decision making and environment of uncertainty and risk using conditional payoff tables and decision trees. So you find decision trees here, or simply decision making under the environment of uncertainty. The other thing that you find here in chapter 3 is expected value of perfect information, and then relevant cost analysis. The other thing you find in chapter 3 will be application of marginal costing, that is non-routine decisions, and limiting factor analysis. And the last thing that you find in chapter 3 will be throughput accounting, including make or buy decision, continue or discontinue, drop decision. Should you make or buy? Should you make or buy the product? Dropping the product. When am I supposed to drop the product? Special order decisions and other short-term decisions. So in chapter 3, that is simply what we will be focusing on. So as I have told you, I will start straight away with CVP, cost, volume, profit analysis. That is break-even point. Because you have done break-even point for a single product, and just as a reminder, break-even point means that point where total cost is equals to total revenue. That's a break-even point. There is neither profit nor loss. If you purchase a product for 1,000 shillings and you sell it at 1,100, then there is a profit of 100 shillings. If you purchase a product at 1,000 shillings and you sell at 900, then there is a loss of 100 shillings. But if you purchase a product at 1,000 shillings and you sell it at 1,000 shillings, there is neither profit nor loss. Now, basically, the break-even point is that point at which the total cost equals to total revenue. And we know that total cost comprises of fixed cost and variable cost. A variable cost is that cost which varies with the level of activity. And the fixed costs are those costs which remain constant irrespective of the level of activity. Meaning, even at the zero activity level, you still incur this cost. A variable cost, on the other side, or on the other hand, will increase as the activity level increases and reduce as the activity level reduces. So break-even point in units, that is if it is for single product, break-even point is given by total fixed cost divided by contribution margin. Contribution margin is given by selling price per unit minus variable cost per unit. So to get the break-even point in units, just take total fixed cost, you divide by contribution margin. In other words, fixed cost divided by selling price per unit minus variable cost per unit, and you get your break-even point in units. If you want to calculate the break-even point in the value or in shillings, you just need to multiply the break-even point in units times selling price. Alright, that is something that we have done in the previous management accounting classes. However, for today, I want us to take break-even point for multiple products. When you have several products, you are producing more than one product, product A, B, C. What would be the break-even point for that particular situation? Now, I want us to take an example here. However, before I take up that example, I want you to Note some important points there. This is the break-even point for multiple products. I believe you do not have any challenge with break-even point for single product. If you have any challenge, just be calling us. We upload that particular class. If you need break-even point for a single product, just call us. We'll do that one for you. Get it then. However, we still have textbooks and revision materials for your research. So feel free to consult us in case you need any help. I'll give you our contacts. So in studying break-even point for multiple products, we are going to do it through illustration from December 2024 question 4A. That is advanced management accounting. Advanced management accounting for CPA, KASNEB, Kenya Accountants and Secretaries National Examination Board. So this is from KASNEB. This is from KASNEB. That is Kenya Accountants and Secretaries National Examination Board. For those who are following us from other countries, that's an examination body which is based in Kenya, which examines public accountants and secretaries, including investment and financial analysts. Right? Maybe you may wish to to become a public accountant or tax consultant or an auditor or investment consultant. You can still study from that particular examination body, which is based in Kenya, Nairobi. Right, away from that, let's go to our discussion now, December 2024, question 4A, and we are studying break-even point or cost volume profit analysis, CVP, for multiple products. Note that we have said that break-even point is that point where the total cost equals to total revenue. Break-even point in units is calculated by total fixed cost divided by selling price per unit minus variable cost per unit. In other words, selling price per unit minus variable cost per unit gives you contribution margin. In other words, break-even point in units is equals to total fixed cost divided by contribution margin. In other words, so find the formula is here. Break-even point in units is given by total fixed cost divided by summation of. Now, this situation, summation of this formula, you use this formula when you are calculating the break-even point in units for multiple products, not a single product. If it is a single product, you just take the total fixed cost divided by selling price per unit minus the variable cost per unit, if it is a single product. However, in this discussion, we are looking at break-even point for multiple products. And that is why if you look at our denominator, we are saying summation of weighted average contribution margin. You have to do the weighting itself because we have more than one product. And that is why we are saying for our denominator, we will be taking summation of weighted average contribution margin. So this part, contribution margin, obviously means the selling price per unit minus the variable cost. Now, weighting now means you have to take the proportion, the sales mix, or the proportions given in terms of percentages, and then you'll be multiplying by that. Then you sum those numbers together. Now, you look at here summation of weighted average contribution margin. We have said probability of A, or just the sales mix. Let me use a sales mix. If, for example, the sales mix is 0.5 for product A, you multiply by contribution margin for that particular product A. meaning you'll be taking selling price per unit, you minus the variable cost per unit for product N, multiplied by the sales mix, maybe 0.3%. Then you plus, assuming that you have two products, you'll be taking the sales mix, maybe 0.6 times contribution margin for product A. Then you plus sales mix for product B, you multiply by contribution margin for product B. Contribution margin, we have said, is given by the selling price minus the variable cost. If you have 3 or 4, you just continue that way, then you sum them together and you will have obtained your denominator, summation of weighted average cost contribution margin. So that is how we go about that. So we can illustrate this one by an example to make it easier. And we have said that we are taking a past paper question from December 2024. I believe you have that question with you. Now let's look at it together. We just look at it together. And I believe you have downloaded your papers. I advise you to be downloading those papers. They are very important. Let me project that question. You can also look at my workings on the other side. Now my question is, you can see, you are told question 4A. You are able to see that. Agrovet Group is a multi-divisional agrochemical firm that deals in multiple products. Delta Division, one of its subsidiaries, makes 3 products branded Betax, Zite, and Halfans. The management is contemplating changing the sales mix in scenario 1 to a new sales mix in scenario 2 in order to maximize the net profit. The 2 scenarios are envisaged as below. Look at scenario 1. The sales cost and output data for original sales mix for the year 2024 for 3 products are as follows. So you can see them from there. Product Betax, Zite, Alphans, and Total. Now the sales mix, as I've told you, these are the percentages, the proportions. Sales mix for Betax, 40%. For Zite, 30%. Alphans, 30%. Then shillings per unit and the selling price for Betax, 2,000. Zite, 3,000. Alphans, 2,500. Variable cost, Betax, 1,000. Zite, 1,800. Alphans, 1,500. You can see the total fixed costs, 15,664,000. Then total sales revenue, 45 million. Now that is scenario 1. But this company is contemplating to change the sales mix to scenario 2. Now look at scenario 2. Agrovet Group's estimated sales costs and new sales mix are as follows. Product, Betax, Zite, Alphans, then Total. Sales mix, 50% for Betax, Zite, 20%, Alphans, 30%. Selling price per unit, 2,000 for Betax, for Zite, 2,800, Alphans, 2,500. Variable cost for Betax, 1,000, Zite, 1,680, Alphans, 1,500. Total fixed costs and total sales revenue, they remain the same, they don't change. Total fixed cost is 15,664,000, and then total sales revenue 45 million. Additional information: 1. The management performance measures are based on cost, volume, profit, CVP analysis. Number 2, the weighted average contribution margin ratio of each scenario is determined based on its sales mix. Required: compute both the break-even point in sales value and the net profit for each scenario. Then number 2, required number 2, by comparing the break-even point and net profit, advise the management of ungrouped group whether it is worthwhile to change the sales mix. You can just pause your video and you record that somewhere, that question, how it looks like. First, go through the question. Go through the question first as we attempt it from the other side. So I believe you have understood that question. Now the first thing is I will analyze scenario 1. And scenario 1, I'll start by calculating break-even point. We have said that break-even point is that point where total cost is equal to total revenue. And it is given by, if it is break-even point in units, total fixed cost over contribution margin. If it is for multiple products, like in our case here, we have product BTAX, ZT, and Alphans. Those are multiple products. Now I will start by getting my summation of weighted contribution margin. So I will take scenario 1. I'm analyzing scenario 1. Obviously, I'm given total fixed cost at 15 million. So already I have this. I have the total fixed cost in scenario 1, 15,664,000. I have that one for scenario 1. I have that one for scenario 1. Scenario 1, you can see total fixed cost 15, the second last item from the bottom. Total fixed costs 15,664,000. Should be able to see that. 15,664,000. Can you see it from the board? You should be able to see that. Then I'm dividing by summation of weighted average contribution margin. So I've told you the formula for computing the denominator. Summation of. Now you take the sales mix for BTAX. Sales mix, you are given 40%. 40%. Then for ZT is 30%. And then for Alphans is also that percent. So what you do is the 40% you multiply by contribution margin. Now if it is contribution for BTAX, it's just selling price minus variable cost. That is 2,000 minus 1,000. 2,000 is the selling price, 1,000 is the variable cost. You have said if you less, that is if you take selling price minus variable cost, you get contribution. So for this part here, what I mean is that it's the 40% for that particular product multiplied by contribution margin, selling price minus variable cost. Now this is coming from that particular point You should be able to see that. If you look at B tax, you can see B tax 40%, selling price per unit 2000, variable cost 1000. So what is the contribution margin? 2000 minus 1000. You multiply by 0.4, the 40%. Then you do the same for the other items. What you'll be plusing is for Zite 0.3 times 3000 minus 1800. Then you plus for Alphans 0.3, you can see it is that percent up there. That percent of 0.3 times 2500 minus 1500. Then you sum them together. That is what we have done up here. 0.4, that is 4%, multiplied by contribution margin plus 0.3 times contribution margin plus 0.3 times contribution margin. If you add all of them, you get 1060. You get 1060. 1060 is your weighted, is the summation of weighted average contribution margin. That's well understood. So that is where my 1060 is coming from. So if you get fixed costs, which are given 15,664,000 divided by 1060, which is the summation of weighted average contribution margin, you are getting 14,777 units. So this is a break-even point for all these items, the three of them. However, they have different sales mix. The proportions are different. You can see the first one is at 40%. So you have to share these to know the first item as what proportion, the second item as what proportion, the third item as what proportion. In other words, out of these 14,777 units, what proportion goes to betas, what proportion goes to zeta, and what proportion goes to alphas. So just multiply for betas. For betas is 40%. So 40% times 14,777, we get 5911. Then the second item, zeta, 30%. It has that percent. The sales mix for zeta is that percent. So take that percent, or just 0.3 times 14,777, you get 44.3. For alphans, the same proportion, that percent, or 0.3 times 14,777, you get 44.3. So this break-even point is for the three items, and I want to know at break-even point what proportion, how many units are allocated to betas, what proportion is allocated to zeta, and what proportion is allocated to alphas. So you sum up this, you just get 14,777, the total units and break even. So we are able to allocate these break-even point units to the three items. Now, that is it about that. I want to know what is my break-even point in shillings. How do we calculate the break-even point in shillings or in value? You just pick the break-even point in units times selling price. So you just pick this. We have the units 5911 for betas, 44.3 for zeta, and 44.3 for alphas. We have the units. So we just need to multiply by the selling price. The selling price have been given up there. The selling price have been provided. You can see them, I can show you. The selling price are there. Selling price. We are doing scenario 1. B tax 2000, zeta 3000, alphans 2500. Those are the selling prices. So I want to know what is my break-even point in shillings or in value. So just taking these values here, the units which have a portion. You see, I started by calculating the break-even point for the three items. I got 14,777. Then I shared this using the sales mix. I got uh, the break-even point in units for each particular uh, product. Then I want to know the break-even point in shillings or in value. I just multiply by selling price. After multiplying 5911 times 2000, I got 11,822,000. Then 44.3 times 3000, I got 13,299,000. 44.3 times 2500, I got 11,082,500. If I add all of them, if I sum up, all those figures, I got that six. I got that 6,203,500. That is the total revenue. Remember that at break-even point, total revenue is equals to total cost. So this can be the same as total cost. And how do we calculate total cost? Fixed cost plus variable cost. Okay. At that point, you should know that we have calculated our total revenue as that 6,203,500. That figure there, that is at break even. Remember, at break even, the total cost is equals to total revenue. Now, so I want to know what is my net profit. What is my net profit? If I want to know my net profit at that point, then I can just pick my total sales, because I can take the total sales minus total cost. And I have assumed that total revenue or total cost is equals to total revenue. And then I can just pick this figure to be my total cost. I can pick that one to be my total cost. So what I do is that I can take 45 million, because how do we get our net profit? I want to know my net profit out of that in scenario one. To know my net profit, I will take revenue minus variable cost minus fixed cost. You can just do that. You can calculate your total variable cost, and the fixed cost has been given. You just less total revenue minus variable cost minus fixed cost. But I can just move faster. I can have a shortcut for that by taking 45 million. I just pick 45 million minus this total cost, that's 6,203,500, because total cost is equals to total revenue. So I can assume that this is my total cost, it is also my total revenue. So what is my profit? Total sales which have been provided. The total sales have been provided is 45 million, as you can see down there. Total revenue in scenario one is 45. Can you see that? Total sales revenue, the last item, 45 million. So that 45 million, you can less 45 million, you can less that 6,203,500, and you get shillings 8,796,100. I don't know whether you'll be able to see that. Let me try to show you that. I try to show you what I'm trying to say. Well, I think we are able to see what I'm trying to, the point that I'm trying to explain here. I'm trying to say that I want to know the profit. What is my profit in scenario one? I've said I've calculated my total revenue this way. I got that 6,203,500 total revenue, and assume that at break even, because you know this is at break even. At break even, total revenue is equals to total cost. So this total revenue, if I was to calculate my total cost, it must be the same as that 6,203,500. So that is my total cost as well. So what is my net profit at that point? I can pick revenue now has been given as 45 million. Total sales revenue, 45 million. Then I will less this, that's 6 million. I get shillings, 8 million, 7, 96, 100. So that is basically what I mean by that. Now, I don't think that there is another alternative of doing it, or you can just do this. If you want to, you can try this. Let me give you another option. Try this. You can say net profit is equals to revenue minus variable cost minus fixed cost. The total cost is equals to variable cost plus fixed cost. Our net profit will be revenue minus total cost. So how do you calculate? You can calculate variable cost by taking 1,000, the variable cost which have been given. You have been given variable cost because you can calculate independently variable cost, then you and the fixed cost which has been provided. Now let me show you another option if you are not comfortable with what I've done here. Now identify your variable costs per unit from that question. Variable costs per unit. I show you that. What I mean. Variable costs, I have 1,000, 1,680, 1,500. Those are my variable costs there. Remember the fixed cost is 15,664,000. So if you take those variable costs for each item and you multiply by the units at the break-even point, you add all of them, then you add the fixed cost, then you have your total cost. So what I'm saying is that you can take 1,000. You see, 1,000 is a variable cost for bitters. 1,000 times 5911, which is here, plus 1,800. 1,800 is a variable cost for zeta. 1,800 times what? 44, 33, plus 1,500. 1,500 is a variable cost for alphas. Remember, we are doing scenario 1. 1,500 times 44, 33. If you add them together, you'll get the total variable cost. Now that total variable cost, you add the fixed cost. Now if you sum them together, that is a variable cost. You have said 1,000 times 5911 plus 1,800 plus, no, 1,800 times 44, that's 3. Now let me repeat that. Total variable cost, 1,000 times 5911 plus 1,800 times 44, that's 3 plus 1,500 times 44, that's 3. So the total variable cost there will be 20,539,900. That's the total variable cost. 20,539,900. Then total cost, you just take the variable cost plus fixed cost, meaning total cost is equals to 20,539,900 plus 15,664,000. You get that 6 million. You just come back to the same figure. It's one and the same thing. So what is my net profit? You're saying it will be 45 million, which has been given. 45 million is total sales revenue minus total cost of that 6,203,500. We get shillings 8,796,100. So that is my profit for the scenario one. Remember, you are told compute both the break-even point in sales. So I have it here. My break-even point in sales is there. Break-even point in units is there. The break-even point in units is 14,777,000. The break-even point in shillings or in value, that's 6,203,500, which is there. Remember, at the break-even point, total sales is equals to, or total revenue is equals to total cost. So this total revenue here is the same as the total cost. Then you were told again, and the net profit, required one. Compute both the break-even point in sales value and the net profit for each scenario. My net profit is there. So note that net profit for scenario one, because Roman number 2, you are told by comparing the break-even point and net profit and advise the management of Agrovet Group whether it is worthwhile to change the sales mix. So note that one somewhere, because I will also calculate the break-even point for scenario 2, the sales in value for scenario 2, and the profit for scenario 2, and then I will compare to advise on whether to change the sales mix. Now let me analyze scenario 2. I want to analyze scenario 2 for you. Now I remind you to download those past papers to make your work easier. Now look at scenario 2. My scenario 2. We had seen that before. Scenario 2. Agrovet Group's estimated sales costs and new sales mix are as follows. You can see BTAX is 50%, ZTA 20%, Alphans 30%. Selling price for BTAX 2,000, variable cost 1,000. ZTA 2,800 selling price, 1,680 variable cost. Alphans 2,500 and 1,500. That is for selling price and variable cost respectively. Total fixed costs remain the same, 15,664,000. Total sales revenue, 45 million. That is my scenario 2. Our scenario 2 is there. We have done scenario 1. Scenario 2, let's work it out. I'll stand by. It's the same concept that I've used previously. I don't know whether you can see scenario 2 from the board. Are you able to see scenario 2? I think so. I think scenario 2 is legible. Scenario 2 is legible. You can see what we have done there. See what we have done in scenario 2. Are you able to see the scenario 2? What we have done? Scenario 2. Weighted or summation of weighted average contribution margin. What have we taken? We have taken 0.5. 0.5 times 2,000 minus 1,000. This one. For BTAX plus for ZTA. 0.2. That is 20%. Multiplied by 2,800 minus 1,680. For Alphans, 0.3. You multiply by 2,500 minus 1,500. If you add all of them, you get this 1024. You got 1024. 1024. That is summation of weighted average contribution margin. Remember what contribution margin is? Selling price minus variable cost. So can you see that analysis there, what we have done? Then you have seen how we have gotten 1024. I believe you understand what we have done. We have just taken our scenario 2. You can see B tax, the sales mix is 50%. So 0.5 times what? 2000 minus 1000. Selling price minus variable cost gives us what? Contribution margin. So you multiply by, that is 2000 minus 1000 times 0.5 that is, plus zeta 0.2, that is 20%, multiplied by 2800 minus 1680, plus for alphans, that percent, that is 0.3 times 2500 minus 1500. You sum all of them. Whatever you get, you can see from the board how it looks like. You can see from the board how we got 1024. This figure there, I've shown you. So once you have gotten that, the next thing is to calculate the break-even point in units. That is total fixed cost over summation of weighted average contribution margin. This one here. The fixed cost remains the same in this question for both scenario 1 and scenario 2. So dividing this by that, we get 15,297 units. So units per product you allocate, this is the break-even point for the 3 products. We know the sales mix for B or B tax is 50%, then for Z is 20%, for A is that percent. So just a portion, 50% times 15,297, 20% times 15,297, 30% times 15,297, and then you are able to know the break-even point in units for these 3 items. If you apportion these units among those 3. Then from there, the variable cost. The variable cost. What is the total variable cost? You are given variable cost for each item. You just be multiplying 7649 times variable cost for that item plus 3059 times variable cost for that item. Then 1500 is the variable cost times 4589. You sum all of them to get the variable cost. I believe you understand what I'm trying to say. To get variable cost in scenario 2. Variable cost in scenario 2. Can you look at those variable costs there? Variable costs, you can see variable cost in scenario 2. We have 1000 for B tax, 1680 for zeta, 1500 for alphas. So it is those variable costs that you are multiplying by the units per product at break even. These items there. When you sum them together, you get your total variable cost, 19,671,620. Total cost, because this is variable cost alone. Total cost, now you add them together. Fixed cost plus variable cost. The fixed cost is given 15,664,000 plus 19,671,620. And then our total cost now, our total cost will be that 5,335,620. Remember, at break-even point, total cost is equals to total revenue. Total cost is equals to total revenue. So at break-even, this is my total cost, is also my total revenue. However, for the purpose of calculating the net profit, the total net sales or the total revenue has been provided in scenario 2. You are given total sales revenue. Total sales revenue in scenario 2 has been given. See it there. Total sales revenue 45 million. The last item there 45 million. So I just pick 45 million. I less what? This total revenue there. Or total cost that is. Because I took 15,664,000 plus. Now this is the total cost. No, the total fixed cost was 15,664,000 plus variable cost of 19,671,620. This one to get total cost. That 5 million. 3 that 5,620 is what I less. So net profit is total revenue minus total cost of that 5 million, 3 that 5,620, and this is my net profit. So in scenario 2, my net profit is 9,664,380. So you are required to answer that question that way. You are told in Roman number 2, by comparing the break-even point and the net profit, and advise the management of Agrovet Group whether it is worthwhile to change the sales mix. So what can you say? Remember, my net profit in scenario 1, I got 8,796,100. In scenario 2, my profit is 9,664,380. So if I change, or if this company changes the sales mix, it means our profit will be more than scenario 1. So it is advisable to change the sales mix. That is how you are supposed to advise that particular company. That is how you are supposed to advise that particular company. Now, end question now. You can check from the top. Check from the top how that question looks like. Check from the top. You should be able to see that. I think you are able to see that. From the top, where we started. So I think we have concluded that successfully. I think we are successful in that. I think we are successful in our question. I don't expect you to have a challenge as at that point. So we had been given that kind of a question to analyze break-even point for multiple products. Multiple products. So we have said that break-even point is that point where total cost is equals to total revenue. For single product, you have done that one in the previous management accounting, and I believe you are comfortable with that. However, we still have those lessons in our YouTube. You can still get in our YouTube break-even point for single products. But in this tutorial, we have concentrated on break-even point for multiple products. So where you are calculating the break-even point for multiple products, note that you take the total fixed costs, which will be provided, divided by summation of weighted average contribution margin. You'll be taking the sales mix. This sign there means the sales mix in terms of percentage, like 40%, like in our case, for that particular product. You see, this is just one product here. You work out that product separately. The percentage given, you multiply by contribution margin. So you'll be taking the selling price per unit minus variable cost per unit. You minus. The answer that you get, you plus, you go to the next product. The sales mix will be given in terms of percentage, like 0.3 multiplied by contribution margin, selling price for that product minus variable cost for that product. You get a certain number there. Then you plus, you continue that way until you have all the products involved. If they are three, they are two, they are four, whichever number you have. You'll be given the sales mix in that particular, for that particular product. Then you multiply by selling price minus variable cost for that particular product. You add the next one until you get the summation of weighted average contribution margin. That is the number that you use to divide by the total fixed costs. Like in our case here, our total fixed cost was given at 15,664,000 for both scenario 1 and scenario 2. So for scenario 1, you got our total fixed cost, which was given at 15,664,000 divided by weighted summation of weighted average contribution margin, which you got at 1060. So by dividing by 1060, we got 14,777 units. So at break even for these three products, we'll be having 14,777 units. Then because these are the three of them, these are the three items involved, we need to know what proportion goes to product A, product B, product C, whichever names have been given. So just multiply, you divide this now, you just allocate these break-even point units, you allocate among these different products using the sales mix given. For product, this one was 0.4 times that, 0.3 times that, 0.3 times that. You apportion them accordingly. Remember, this must give you 1 or 100%. This 40% plus that percent plus that percent is 100%, or 0.4 plus 0.3 plus 0.3 gives you 1. Then, once you have known that, you can calculate the break-even point in shillings by multiplying these units by what? Selling price. The selling prices have been given 2,000, 3,000, 2,500. Then you sum them together to get the total revenue or total sales revenue at break-even point. This total sales revenue at break-even point is the same as the total cost at break-even, because at break-even point, total cost is equals to total revenue. Then, out of that, you can get your total profit by taking total sales revenue, which has been given in this question. Now, you not use at break-even, because if it was at break-even point, there is no need to calculate any profit. At break-even point, there is neither profit nor loss. So the total cost will equal to total revenue. So my total revenue, that 6 million here, will equal to my total cost. However, in this question, we have been given total sales revenue, 45 million. So if I'm using 45 million, I'll take 45 million. I minus, if 45 million is my total revenue, as at this question, I minus this at 6 million, assuming that my total revenue is equals to total cost. So total revenue of 45 million, I minus that 6 million, 203,500 to get my net profit. That is my analysis for scenario 1. For scenario 2, it will be the same concept, only that here, the management is proposing changes in sales mix. Like for example, this B from 0.4 to 0.5. Then C, or the second item, they use 0.2, the other one they use 0.3. So what will be the net effect for these changes? So the calculations will remain the same, like what you have used in scenario 1. Only that for scenario 2, you'll be using different numbers. If it is for summation of weighted average contribution margin, you use 0.5 instead of 0.4. And then The break-even point in units, the fixed cost remain the same. The weighted average contribution margin will be 1024 instead of 1016 as you have calculated here. We have shown that. Then units per product, your portion accordingly. This 15297. This figure here, the break-even point in units, your portion according to the sales mix. Then you can multiply by selling price to get the total sales revenue in shillings. And then you can establish your total cost by calculating variable cost. And then once you get the total variable cost, you plus the fixed cost to get your total cost. Then just take 45 million minus the total cost to get your net profit. So you can advise by comparing the net profit in the first scenario, which you got 8,796,100. You compare with 9,664,380. And in that case, you advise the management to change the sales mix because you get more profit out of that. So that is enough for that. I'll give you an exercise, so you can take the exercise. Now let me not give you an exercise for today. I think you first digest what you have done here. We can take that next question, the next lesson. I can take two more questions or one more question if you have understood. We don't need to repeat. You can just, if you understand the concept here, we can just take one more question and then we move on to something else. So for details for inquiries plus 254 727 87 10 93. That is our number. 254 is the code for Kenya. Code for Kenya plus 254, the code for Kenya. For those who are within the country, just take, you can just start with 0727 0727 87 10 93. 0727 87 10 93. For those who are following from other countries and you need to make some inquiries or clarifications, plus 254 727 87 10 93. We still have physical classes, online classes, we have textbooks, revision materials. You can still contact us through that number there. So remember to subscribe for YouTube, Fatima Institute. You like the video, you make a comment, and I advise that you subscribe so that whenever we have a lesson, you are notified. You are notified about the lesson so that you may move together. Remember, we have these examinations by the first week of December 2025 for KASNEB examinations. So I advise that subscribe so that whenever we have a class, whenever we upload a class, you are notified and you compare with what you are studying elsewhere. If you are not part of our students, that will be very important for you. The other classes are ongoing. That is advanced financial reporting, advanced financial management, auditing and assurance, all the classes for ATD, for CPA Foundation, CPA Intermediate, CPA Advanced, CIFA, that is a Certified Investments and Financial Analysis. All other classes are ongoing. So if you need a special class or you need a special arrangement, we assist you. The number is there. We're just given the number there. And I request you kindly, you subscribe so that, because by the end of this month, we'll be winding up our discussions, and then next month we'll be doing a revision, which is very important for you. So you can subscribe so that when we start our revisions, you benefit more. So we stop at that. I think this is quite clear. If it is not clear, if you did not understand any point there, you can just call us, and then you can tell us, you can request us to clarify that. So can we meet tomorrow? Tomorrow I think we can take one more question for break-even point multiple products. So chapter 2, get those, chapter 2 is in the YouTube, very comprehensively covered. The computer output input analysis, ANOVA, things like plausibility tests, things like least square method, things like high-low method. So chapter 2, we covered chapter 2 comprehensively. So just go to our YouTube, Fatima Institute. You'll find those questions and answers there, and other classes are there. So don't worry about chapter 2. It is already in the YouTube. You get them from there. Chapter 1 is just a theory work. So if you need help for chapter 1, just call this number. I can send you that particular chapter in form of a soft copy. Chapter 1 alone. You provide me with your email. I'll send chapter 1 in a soft copy because it is just some theory work. Chapter 2, if you have a problem, go to our YouTube. Those questions and answers are there, including lessons. Chapter 3, you have just started, so you just need to join us and then you subscribe so that the next classes you'll be notified about the same. So, thank you. We meet again.